You look at a financial chart and you think, okay, it's one market, one game, right? But what if I told you there are actually two completely different games being played on that very same field by two very different types of players? In this explainer, we're going to break down who these players are and how their totally different strategies are what really shape the market you see every day. Right off the bat, let's just get this out of the way. The market is not a level playing field. Not even close. It's a complex jungle where different players are operating with entirely different rules, tools, and most importantly, different goals. And once you get that, everything else starts to make a whole lot more sense. So, who are these players? Well, on one side, you have retail traders. That's probably you, it's me, it's anyone trading from their home computer. And on the other side, you've got smart money. We're talking the big institutions, the banks, the hedge funds. And believe me, it's not just about the size of their bank accounts. They are playing a completely different sport. Okay, so this fundamental difference in who they are leads directly to a massive difference in what they're trying to accomplish. Let's dig into their goals, because you'll see they are literally polar opposites. Just look at this. The contrast is night and day. A retail trader, well, their whole world is about being right, predicting which way the price will go, catching that big move. But smart money, their game isn't about being right on one trade. It's about their process, how they can efficiently get into and out of massive positions. And to do that, they need one thing above all else: liquidity. You can think of liquidity as the available pool of buy and sell orders at any price. It's the oxygen they need to breathe. And let's be super clear about who smart money is. It's not some secret club. It's simply any institution, a bank, a fund, that's trading in such enormous volume that they can't just click buy or sell like we do. They have to find a massive number of people willing to take the other side of their trade, which means every single move has to be carefully, deliberately planned. And this right here, this is the key. While retail traders are often reacting to what the price is doing, chasing breakouts, getting caught in breakdowns, smart money is proactive. They work to actually engineer the conditions that will create the liquidity they need. Get this, they aren't just following the story. In many ways, they're helping to write it. So that brings us to the absolute heart of this entire dynamic, the constant, critical hunt for liquidity. This is the fuel that makes the market engine run, and understanding who needs it and why is pretty much everything. So how does smart money find all this liquidity they need? Well, it all starts by asking a really simple but powerful question. Why is the behavior of millions of individual traders so incredibly easy to predict? And the answer, when you break it down, is a pretty straightforward progression. First, retail traders are taught from books, from courses, from everywhere to trade the exact same way. Buy here, sell there, put your stop loss in the same obvious place. Second, because everyone's learning the same thing, their behavior becomes predictable. And third, and this is the aha moment, that predictable behavior creates huge concentrated pools of orders at those obvious levels, and that is liquidity. Now, this leads to probably the single most important mindset shift you can make. It's not personal. Smart money isn't sitting there thinking, let's go hunt for Bob's stop loss. No way. It's a totally impersonal mechanical process. They are targeting the massive clusters of orders, which yes, includes your stop, because that's where the fuel they need to operate exists. I mean, think about it. A stop loss isn't a maybe. It is a forced market order that has to execute once price touches that level. So when you get thousands of these forced orders all stacked up together just above a key high or just below a key low, you create this deep, juicy pool of liquidity. It's a gold mine for an institution that needs to fill a gigantic position. And that's exactly why you see price so often smash right through those levels everyone is watching. So how does this change how they look at the market? Well, it means that when these two groups look at the exact same chart, they see completely different things. They're living in different realities. Here's a perfect example. A retail trader is trained to draw lines on a chart. Trend lines, support, resistance. They see geometry. But smart money, they look at that same chart and they see a map of human emotion. They see where traders are trapped. They see where the clusters of stop losses are sitting. They see exactly where the forced buying and selling is about to kick in. And this difference in what they see explains something that probably drives a lot of traders crazy. Why does it always seem like the professional entries happen at the most uncomfortable, most counterintuitive moments? Why do they often look just plain wrong or way too early? The answer is all about confirmation versus necessity. See, retail traders are taught to wait for confirmation, wait for that big green candle, for the clean breakout, for the indicator to give the all clear. But here's the catch. By the time that confirmation arrives, the liquidity is gone. Smart money has to enter before the confirmation, right at the moment of peak pain and discomfort for everyone else. They aren't getting in because it looks or feels safe. They're getting in because it's necessary to get their orders filled where the liquidity actually is. So here's the really crucial takeaway from all this. Retail traders aren't really in competition with the big institutions. It's not a direct fight. Instead, the collective, predictable behavior of retail is what provides the opportunity, the liquidity, that allows the bigger players to operate in the first place. And let's be 100% clear on this. This isn't about calling retail traders stupid. Far from it. This behavior, this dynamic, is a necessary part of the market ecosystem. Without the predictable actions of retail, the late entries, the panicked exits, markets would be slow, they'd be thin, and they'd be incredibly inefficient. In a way, retail is the fuel for the entire engine. Okay, so with all this context, let's finally pull back the curtain and look at what the real game is and why so many traders struggle without ever really knowing why. The uncomfortable truth is that most retail traders lose money. But it's not because of bad luck, and it's not because the market is just random. It's because they're unknowingly playing the wrong game with the wrong rules. They lose because they're playing a game of prediction, while the real game is about liquidity. They lose because they react to what price is doing instead of anticipating where liquidity is going to be targeted. They're trading based on confirmation, which, as we've seen, is often the exit signal for smart money. They're simply playing on the wrong side of the board. So what can you do? It's all about a mental shift. It's about changing the questions you ask yourself when you look at a chart. You have to stop asking, is this going up or down, or is this a breakout? And instead, you have to start asking, who's trapped here? Where are people being forced to act? And where is the liquidity? That question, that's the dividing line between retail thinking and professional thinking. And that really just leaves us with one final critical question. Now that you understand the two games being played simultaneously, you have to ask yourself, are you setting yourself up to play the game to win? Or are you, without even realizing it, simply providing the fuel for someone else's game?